We get calls from people who just have no idea what's going on in their retirement plan, and they know they have to do something, they know they need a change, but they don't know what to do or where to go, and that's why they're calling us.
I think the main draw is the concern to run out of money, and I think they're looking for some type of answer. You're not taking double-digit losses, you don't need double-digit gains. Is an extra 5% really worth risking your whole retirement on? When you remove the emotions, it's an objective situation. It's not opinionated. Here's the money that you have. Here's what's at risk. Here's your liabilities. Here's the gap. What do we do?
Hey, welcome back, everybody, to the Greenlight Retirement Show. I'm your host, Brian Lindberg, and I'm joined by Tim and Corrine Fitzwilliams. How are you guys doing?
We're doing great.
Doing wonderful.
Always fun to get back and do this.
All right, and down in the Sunshine State, Mr. Ron Wright, how are you doing down there?
Hello, doing great down here. Good to see everybody.
Well, great to have everybody here today. Boy, do we have some things to talk about today.
Absolutely.
The geopolitical climate's heating up just a little bit. We got people worried about oil prices, World War III, closing or the Straits of Hormuz and things like that. So let's jump right into it, Tim. I mean, everybody's really concerned about this. Like, where do we want to begin on that?
Yeah. So as of the time of this recording, we're looking at the point of things where we have Israel and the USA has attacked Iran and started taking out its navy and taking out its leadership. And so the big question is what is the net effect on oil prices? Because right now in the market, you're seeing knee-jerk reactions, as we like to call them, quick emotional responses and a little bit of a flight to safety. So people are concerned because there's uncertainty. You see, when there's volatility, it always comes along when there's uncertainty, when you're not sure what's going to happen. And there's different types of volatility. You can't just compare a war with Russia and Ukraine, for example, and the US, Israel, and Iran. You can't do that. There's different factors at play. And so the good news, if there's good news out of this, is that one, the liberation of the people, but the other on the economic side is that the oil is almost negligible in regards to the actual financial impact of the total production of the world's oil, which I was just doing some research before I went on our local news for my weekly live, and Ron and I were chatting it up about it, and it was unique and interesting that he brought up that the U.S. is the number one oil producer right now.
Yep. Hasn't always been that way.
Yeah, by a large margin. We're looking at Iran as like single-digit percentage of the world's oil production, and the U.S. was around the 20 percentile. So
now,
that's pretty wild.
From like a regular person's point of view, though, do we feel like because there's so much going on in the world, when I was in the Navy and there was like a government shutdown coming to happen, we would suddenly be a little bit more cautious about our spending. We'd be worried about what might happen, so we would kind of hold back. It never ended up actually affecting, well, not me at that time frame, but do you feel like these things that shouldn't affect the market are going to affect the market just because of the general public's emotions?
Absolutely.
And just choosing, yes. Is it going to be enough to make drastic changes? Or are these little hiccups?
So that's a great point. Is it a short-term thing or a long-term thing? And I think if you look at it from a common sense perspective and the advancement of technology, what you're going to find is that wars nowadays can be ended in a matter of weeks and not drawn out over years. I think Ron can really speak to the fact of the economic impact in regards to the dollars and cents. So right now we're seeing that knee-jerk reaction. We're seeing oil prices change. But what actually has to happen, Ron, in regards to the oil prices, what do we need to hit before it starts to become an economic concern?
Right, yeah. So and kind of tying into Corinne's point, I think of it in terms of there's a psychological aspect to it, market psychology, and then there's a structural aspect to it, which is the real thing that's actually happening. And the two don't necessarily line up, right? The psychology can get people running in wild directions. when the structural part of it hasn't really made that much of a change. And that is kind of what we're seeing on the oil side here. I've done some analysis and read some really great research pieces on this that are looking to see, okay, what happens if it stays around 80? Right now it's around 80. What if it stays around 80? What impact does that have on inflation and on growth for GDP?
Mm-hmm.
So what happens then if oil goes bonkers, right? It pops all the way up to over 100. What if it hits 108? Then what are we looking at? And so, or what if this thing gets handled very quickly and then oil drops back down to 65 again? How are we then? And so we look at these things and put some percentages, percentile probabilities on them. But so let's take the case of 80. If it stays at 80 for a little while, for an extended period, then that will likely have about a 0.3 increase in inflation.
Wow.
It's noticeable, but it's not.
It's just a little tiny bump. It's negligible
Right.
almost.
Right. It's enough to make the Fed pause and say, no, we're not going to raise rates because we got this. But it's not enough to really disrupt. And if we stay around the same level for an extended period, the impact on growth should be negligible, almost zero.
Wow.
Mm-hmm.
And so what timetables were you looking at that when you're saying extended period? Were you looking at weeks, months?
Well, that would have it stretching into months.
Months? Okay, so you're saying if it stretched into months, which we don't really think it's going to, at least not at the hot and heavy level that it is now, you're saying that it would almost be negligible. And of course, we don't have a crystal ball, but research is research and analytics is analytics, and this is your assumptions that you've come up with based on your research, which is what you do.
Right.
Okay.
Right, exactly. And
I had
so,
I was going to say, I have a question on that because, a lot of times when we look at inflation metrics, they exclude oil from the inflation numbers. And I was just wondering if this is a primary driver or we're looking at, say, secondary impacts. The price of oil, obviously petroleum-based products are used in other products and those flow through to consumers. Were you looking at just the primary side of the inflation or these like secondary drivers of inflation?
Like energy,
this is
stuff
a
like
look
that?
at, so this is more a look at broad inflation impact, so CPI.
Fair enough.
That's a really good point, Brian, because the Fed does not look at consumer price index when they're talking about setting their policy. They look at the PCE, the core PCE deflator.
Yeah.
So the core personal consumption expenditures deflator, which excludes the prices of food and energy,
Right.
because those are more volatile and transitory. And quite frankly, monetary policy in a short run has almost no impact on the price of energy.
Yeah.
So there's not much they can do about it on a short term.
It would have to be dramatic, right? It'd have to be super crazy dramatic.
Well, and to that brings me to the second level of the question for me then. So to the point of it staying at 80, I get where it could be negligible. If it does get more dramatic in that, it might not pick up in CPI directly, but people might feel less wealthy, the negative wealth effect of a higher price of gasoline because they pay more at the pump, costs them more to get to and from work, vacations get more expensive, plane tickets get more expensive, cruises are more expensive, etc. That's more of the prolonged, more significantly higher priced oil.
Well, and that's another one of those cases where it flows into the psychology rather than the real structure, right? So the average budget doesn't spend all that much money. I know it sounds crazy, but on gasoline, 3 to 5% max.
Wow.
Of the average budget is spent on gasoline, but we are impacted psychologically by it because we see the price. When we drive by all these gas stations every day, and so we see that moving up. And of course, 3 to 5, that depends on the size of your budget, but in general terms.
Sure.
Now, corporate America can take advantage of this emotion, right? And can purposely raise things even though they don't have to.
Well, we've seen that, right? We saw that post-pandemic with the supply chain.
Exactly, with the
dilemma.
chip in the Corvette, right? You're going to pay
Yeah.
20 grand over sticker, or whatever. It was ridiculous because of we couldn't get a chip to put in the car. And guess
Exactly.
what?
And all
That
that
game is
depends
still
on-
being talked now.
Yeah, and all that depends on this going on for an extended period. If we can get this thing resolved and I believe, Tim and I talking about it, we were like, yeah, this makes sense. We're talking weeks, not months.
So,
you know,
folks that are out there, watching our show, listening to our show, that are just the average retiree, they have their money in the TSP, the G fund, something similar to that in their 401k. Is there anything that they need to be doing to prepare or to protect themselves from these little bumps to ensure that if they are getting closer to retirement, that it's not going to be on the downside of one of these little hills?
I think it's a great reminder, Corinne. I think it's not that they need to do anything because we feel like it's a tiny bump that's not going to have a great impact. However, it's a bump to make you think, do I need to make sure that I have an income plan in play? Do I need to make sure that if I stop working, that I'm comfortable? Maybe I'm just fed up of the emotion in the world and different things. I'm like, you know what? I just want to go live my life because maybe you can't travel to Mexico like you planned on because there's something going on, right? Who knows? So I think these reminders, if you will, these little reminders and the fact that they're not going to greatly affect your portfolio, they are significant events. I'm not trying to belittle those, but in regards to your portfolio, they're little nudges, but they can be good reminders. And that's what it's all about, is reminding yourself to have a plan, to sit with the fiduciary, to sit down and understand what you want to have happen so that if an event does take off and even gets worse than this or gets more dramatic, you're prepared and you're comfortable for you and your family to continue doing what you like to do.
Just as a quick reminder for everybody on the Greenlight Retirement Show, this is an educational show, and you guys should seek your own fiduciary financial advisor. You can always give us a call at 757-961-0700 or visit us on the web at www.fitzwilliamsfinancial.com. Hey, everybody. Welcome back to the Greenlight Retirement Show with Brian Lindberg here and Tim and Corrine Fitzwilliams and Ron Wright. We left you off in the last segment. We were talking about oil. Obviously, it's a big conversation around Iran and potential geopolitical conflicts. Tim, we were talking in the break, we wanted to, table for conversation. Do we actually receive or buy any oil from Iran right now?
Yeah, no, we really don't. The concern is it's not so much that we're using it, that they can control other people having access to their oil. The reality is if they do that, those other countries are not going to be happy and are probably going to attack them as well because nobody's going to just take that. So from a common sense perspective, no, we don't use it and no one else is going to have to worry because if they do step up and try to, I believe it's the Straits of Hormuz, if they do try to take that over and to control the shipping lanes there, other people are going to be upset and they're going to basically stepping on their toes, and that's going to create more drama for them, which they're not going to want. So in short, I think the answer is no, but I think it's also important for us, as we were talking about last time, is how you want to sit with the fiduciary, you want to not have a knee-jerk reaction. I'm proud to say that we didn't have a knee-jerk reaction, and our clients, we're trying to lose less than what the market is, and we have some evidence that we've lost less than what the market is currently losing. And to me, there's a value in that. When you can lose less, you can make more.
So, Ron, how do we target those types of opportunities to lose less in situations like this?
Well, I pull out my crystal ball and I say a few special words. Now, there's this. Look, the last thing you want to try and do is to time the market. Nobody really can time the market. The worst thing that can happen is you get it right by luck one time, and then you keep trying to do it again, you end up losing everything. So we don't take that approach. What we do is look at risks. Corinne was talking about, you look out there and it feels like there's a lot of risk across the globe, a lot of stuff going on. We look at this from a bunch of different perspectives and start thinking about, okay, how risky is this environment? And how are people going to react if there's a lot of risk and people get anxious and then they're ready to jump and they do these knee-jerk reactions? We want to get ahead of that. So what we do is we monitor the general levels of risk that we're seeing globally and in the different markets. And then we start to position our portfolios to get ahead of that. So we don't want to be caught, driving a high speed sports car and all of a sudden you wind up in a snowstorm.
Right.
We don't want to be that.
When did you start making adjustments, and what were the things that you saw that made you want to make those adjustments?
Throughout the last 12 months, we've been moving more and more into more defensive, value-oriented positions. There's a lot that's been going on in terms of interest rates and the Fed. There's been a lot that's been going on geopolitically that has led us in that direction. And then also in the markets as well. The Mag 7, the big cap tech, AI boom, all these things have created some really out-of-line valuations.
Yeah,
So
absolutely.
we watch for that,
I agree.
and we limited our exposure to those.
You have the benefit that, like, when I go to the casino, I sit at the roulette table and I'm either doing all my chips on red, all my chips on black, or I'm picking specific numbers. And it's like, I'm either going to win or I'm going to lose. But with you, it's not like being at a roulette table. You're more like a gardener who's out there planting all these different things. And if one doesn't grow properly, the other is going to be overly producing. So you're kind of protecting yourself with your placement of stuff, right? It's not like all just in Mag 7.
Right. Yeah. We're not putting it all on one, and we're watching it. And we take different levels of measured risk. So sometimes we want to expand that out a little bit and maybe get into some emerging markets and take advantage of that. We've held gold in our portfolio for nearly 2 years now as a core holding, and that's paid off handsomely for it because we saw that the Fed was going to be lowering rates, and that would weigh on the dollar, and that will give gold an impetus to go up. So we're looking at these things across the board, and we try to be agnostic about where we go. In other words, I'm not married to any one specific thing. Right. I just want to make sure that we go where it's going to do the best.
That's really important. I think it's a good opportunity for us to restate again. We're talking a lot about different sectors and asset classes, and by no means is that an individual recommendation for anybody. We're just talking from an educational perspective. That said, though, on the educational piece, where you place your investments at any given time, we also take an active strategy towards this. So to your point, being not married to them, we're not necessarily in these asset classes forever. This type of a strategy, a portfolio management, is not a buy and hold forever. No disrespect to that strategy. It's just not what we do. That said, there's a lot of good research data that says somewhere in the neighborhood of 90 to 95% of your portfolio returns come from just being in the right place at the right time. And so one of the things that's important to us is not to have drag on the portfolio, meaning those strategies that own a little bit of everything and just overweight or underweight those strategies. You wouldn't want to have a 2.5 or a 5% allocation in something that had a low probability to do well. You put those players or those sectors on the bench for a little while, and then every dog has its day. You'll get back into that sector when, maybe the sun is shining a little bit more on that sector.
Ron probably has a smarter quote than this because I'm paraphrasing something I know I've heard him say, but in the past he's made a comment about if you're getting to it once you hear about it being popular, you're too late. Like he's doing his planning and researching and stuff long before, like when Tim comes to him and says, "Hey, I heard about," Ron's like, "Oh, I heard about that 3 months ago. We already did the research. Didn't want to buy that shirt. Nope."
Yeah, that's the idea. Is he's getting ahead of it through proper research and analysis on a daily basis that allows him to make portfolio movements on a weekly basis through rebalancing. That is our whole intent and goal, to try to target losing, less than half of what the market loses. That's our target. That's our goal. And I think what Brian's saying is just, when you're moving, you're aware of concentration risk. You're switching out sectors. And I think that comes down to your lens theory, right? On, which lenses you're looking through to determine which sector you want to use. Is the economic lens, the psychological lens, right? And in this case, I think it's more of the economic lens that you were looking at, as we were kind of towards the bottom of the market. We thought we were kind of at the base, right?
Right. Yeah. We were setting up our position as what we call late recession, early recovery. So moving into what we call stage 2 of our model. So that's early recovery. And so we're getting positioned. And what Brian was hitting on, that I wasn't understanding his question, but he's exactly right. We seek to do what's called optimal diversification. So a full diversification, you just buy a little bit of everything out there and you spread your risk across every asset class. And if one goes down, you're okay because you're balanced out by the rest. But what we try to do, if you're familiar with how MP3s were made, MP3 is a compression that you use for sound. And they discovered that they can make recordings take up much less space on a hard drive by eliminating the frequencies that the human ear can't hear. And so we turn it from the full audio to an MP3, and it saves all the space. It's much more efficient, and we're able to do more. We kind of do the same thing when we're talking about asset classes with our asset allocation. We pick and hold the ones that we see will be the best in now and in the next stage, and we avoid the ones that are going to be the laggards. And that rotates through as we go along.
The last thing I want to say before we close out this segment is earlier Tim had mentioned about rebalancing weekly. We've had clients in the past that came on board with us and they have accounts that only get rebalanced once a month or some even once a year. When you talk about rebalancing weekly, it's not like something you sit down every Friday and do. It's throughout the week, right?
Well, throughout the week we're watching, but we do have a specific day every day that we target systematically to do that. So therefore, that keeps us on a system to be doing it, but we're not regulated by that, as it were. We can make a move whenever the move is necessary, and we will make those moves. But to keep it on a structure that we're following, we do that. We target one day a week for that.
That's important to know. So if you guys are out there, have a financial planner, doing it yourself, and if you're not actively rotating through your sectors, paying attention to the economic cycles and seeing which sectors are going to be most beneficial, I think there'd be a great opportunity for us to give you, have a conversation with you, understand what your goals are. You give us a call at 757-961-0700 and visit us on the web at www.fitzwilliamsfinancial.com. We'd love to help you out. We'll be right back. Hey, everybody. Welcome back to the Greenlight Retirement Show. Boy, we are hot on investments right now, and that's fantastic. I think it's awesome. You should think it's awesome. We have to relate it at some level to planning, ultimately speaking, because investments are great. If you're still working, you got 20 years to retirement, we'd like you to stay tuned in, but we're going to talk a little bit more specifically about where the rubber meets the road with financial planning, and we're going to talk specifically to you pre-retirees and retirees out there, because this is where it's really important. The emotions in investing matter a whole lot less when you're in your 20s and 30s. Emotions in investing gets very, very real as you get into your 50s, 60s, and in 70s. And, it's okay to have a basket of investments, but it's also better if you have a plan behind those investments so that you can have some function with your overall portfolio and get some value add out of this. So we are going to get deep. We are going to talk about planning. Again, it might sound and feel like these aren't individual recommendations. It's educational only. Would love for you to give us a call at 757-961-0700 or visit us on the web and book your appointment at www.fitzwilliamsfinancial.com. But let's kick it off, Tim. What do our clients, our prospective clients that are kind of interviewing us, what do they feel when they come in the doors and they hear and feel some uncertainty out there in the markets? What are you guys hearing in the conference room?
Yeah, absolutely. Well, we love to have a balanced approach, right? We love to have a blended approach. And in the nerd world, we call that asymmetric risk. In the common sense world is, could you have something in your portfolio that could, at some level, feel like a bond, but you could draw down on that account forever and it never run out of money? In other words, you would continue to get your paycheck. And to some people, that's appealing, which is building a private pension, which is doing that through the use of insurance products such as annuities. That can make a lot of sense, especially if someone's looking to do a conversion where they have a taxable account. They know it's going to turn into income anyway. Why not draw down? And what's amazing, Brian, is the percentage rates that you can draw down on. And we're not talking about 4%. Like I said, if you want like a bond style solution, but you normally would be thinking maybe I'll draw down 4% as the old rule says, right? We're talking drawing down like 10, 11, 12% for people in their 60s.
Yeah, it just depends on your age and how long you're willing to wait with the company and things like that. But yeah.
And then that's going to give you an income stream that you can't outlive. So Corrine, when you've talked to people, right, what did you find and how do people feel about having that safety net, right? We've talked about the market. We're talking about now having more of a balanced approach.
So most of our clients are couples, and you tend to see a lot of husband and wife situations where the husband's very excited about the stock market, and the wife is the one that's a little bit more interested in the protective side, having that income
they
that
have a
you
difference
can't
of opinion
outlive.
on risk, for sure.
And I think a lot of that also stems from the fact that women are most likely to live longer. So having that income that you're not going to outlive, did I say that right? Income that you won't outlive. It doesn't even sound real. Like, it's just really important to a lot of these older women that they already know that they're going to be taking care of their spouses as they get older. And they are terrified that they're going to end up having to have their kids take care of them and that they're not going to have enough money to make that happen.
Well, yeah, because if you're planning on doing things and a pension goes away, right, that's a major concern. If a pension that your husband had, well, you know, like you didn't take the SBP, for example, the survivor benefit pension in the military. Well, then when you die, that's the end of that pension. So you're right. I could see how that could be a major concern. Or Social Security, you're only going to keep one of the two, the greater of the two. So that could be $5,000, $6,000, $7,000 of income easily that's no longer coming in monthly.
We also see a lot of situations where, you know, you have somebody who is on their second spouse. So they had a wife and when they were in the military, and that TSP and all that was already put into the ex-wife's name. But now you have this new wife, you've been together 10 years and you want to ensure that they're taken care of. And, you know, you can't change your information on your right. accounts after you've already signed it and moved on from that. So being able to take some of your funds and put them into an account and kind of have that earmarked for this purpose is a really beneficial way to ensure that you're protecting your future.
So you have this large account that's taxable, right? It's ordinary income. It's going to turn into required minimum distributions at a certain age. So no matter what, it turns into income. So you might as well enjoy the ride. Have the income come in, convert it over, whether you put it into a brokerage account or Roth IRA. That's really more of your emotional feelings on that. But the fact is, it's no longer in a qualified ordinary income style account, right? You're taking those distributions. Maybe you're taking larger distributions because you want to convert more, and you can put that into after-tax dollars. Now your kids aren't getting crushed by taxes when you pass and you leave this asset to them.
You know, one of the things that I also love that we do that a lot of other advisors, like when we go to these company meetings and stuff and we go to these trainings, you know, we're one of the few advisors out there that have an in-house tax team. So
right. When
you talk about taking out more now so you don't have to pay the taxes on it later, it's not like some guesswork going on.
No, it's math.
It's literally you have a whole team that's back there
for sure.
crunching the numbers to see how close are you going to get to this tax bracket before you jump up to the next tax bracket
right.
and have that increase in pay, as well as how it's going to affect your Social Security and your Medicare and all that stuff. And that's a really important thing when you are planning for your retirement, to know how all the different puzzle pieces work together. So having some team like us, where it's life insurance, it's annuities, it's tax team, it's the trust being done and your estate plan being looked at, and the assets under management, having this whole team is something where I've always loved when we sit down with our clients and it's like we're able to fully protect them. It feels more like you're a GP at a doctor's office and you instead of like a surgeon that can only do brain surgery.
Right. We
like
have the surgeons, but we have the full practice and all the surgeons in-house. Yeah, that was the vision, right? To bring Wall Street to Main Street. That's what you and I have always wanted, and that's what we've accomplished. And, we've now copied and pasted that into various branches in Miami and Raleigh and Newport News and, of course, here in lovely Chesapeake. So
don't forget Williamsburg.
And Williamsburg, yeah, absolutely. Yeah. So this is a great thing to be able to do that. And I can't stress enough, a lot of people are not excited about the idea of having a private pension. But even if you are that guy and you're like, man, I don't like annuities, I'm not interested in the private pension, but you love the market, it still makes a lot of sense to look at your bond portfolio in the market, shift that out maybe into a bond alternative model such as an annuity, and then go pedal to the metal on your risk in the market. It gives you the freedom to do that without having to explain to your wife why you lost 40% on a bad decision in the market. You're going to have that hedge to protect you that's guaranteed, but won't lose money from market volatility, which is a powerful statement. And right, that's a powerful statement to say that, but it is actually guaranteed to not lose market value. Then you're good. Now you can go push harder into things that you're excited about. And we have portfolios for that, where it's 40 stocks and that's it. No bonds, pedal to the metal, let's drive, fast car, right? We have those things, but it's much more comfortable. Even from the advisor standpoint, it's more comfortable to recommend a portfolio that drives at that speed, if you will, when I already know you have a hedge.
Well, what I hear you guys talking about is a lot of the clients feel, maybe uncertain given the economic times. Nobody gets to pick the economic scenario that they retire into, and
Exactly,
God love the people that are going, going to retire here with, World War III style headlines that are out there. That can be unnerving for sure. But if we're to distill down what you guys are talking about, you're simply just talking about the balanced approach being a percentage of your total assets geared towards providing you the income that you need in retirement, a percentage of your assets geared towards, long-term growth and hedges on inflation and things like that. I wanted to steer this conversation just a shade and say, for the market-based person, Ron, can you talk a little bit about how the portfolio income works?
Well, right before that, I got to jump in here because you said something about the World War III headlines, and you're right. And that's when emotions at its highest. I just want to say this. Who do you think some of the last company standing is going to be if it did go that far?
I know where you're digging there.
It's the insurance companies, ladies and gentlemen.
100-year-old insurance
It's the
companies.
100-year-old insurance companies. That annuity is probably still going to be around.
I just don't want to leave out the market-based person. Talk to us about if you, we're still talking about a percentage to solve a problem, right? If you need income in retirement, we're talking about a percentage of your overall assets geared towards solving your income problem. How do you as a portfolio manager then, Ron, gear an income-based portfolio? What are some of the things you think about? What are some of the things that you do as you build that out?
Right. So we want to make sure that the portfolio is going to provide the income stream as smoothly as possible and as efficiently as possible. So if we're starting to build a new portfolio, we actually have a portfolio model that is geared towards this. It's called our current income model. And it is designed to produce a stream of income that can be taken as a distribution at any time for the client and designed specifically for use in retirement. So we design it around income producing securities, not necessarily bonds, although bonds can certainly play a good role in that. But there's a lot of other income producing securities that can have two kinds of growth. One is in the income itself. Might it be interest, could be dividend income. And dividends are fun because dividends can grow. Especially in terms of utilities. We've seen a lot of utilities increasing their dividends over the last few years because their cash flow has been so strong from all of the AI power needs, right? So that allows us to put into place a portfolio whose income-producing properties actually grow over time. And that can help to offset the effects of inflation as well, as we're going against that.
But just to be clear, and you know, none of us are leveraged one way or another. It's all about the client fit. But as the market portfolio manager, you even have to still admit, though, that current income portfolio is not going to be as guaranteed, right?
Oh, absolutely. It is not guaranteed.
And so that's when they work together well, right?
Yeah, exactly. That's one of the things that brought us, together, was the ability to harness the safety in your side of the shop with the growth in my side of the shop.
Absolutely.
I've always loved that.
Love that. You're right. That's the blended approach.
Yeah, we focused a lot on income and growth here in this segment. I do think we missed one thing, especially for our local folks here in the Hampton Roads area who are predominantly what we like to call pension rich, and maybe they have selected survivorship. So if you've been hanging in there with us for the last segment here and you want another strategy about another retirement fear of maybe not having enough money for, say, long-term care of end-of-life expenses,
great point.
we're going to transition in our next segment, and we're going to talk a little bit about how you might not have an income concern, but we could solve a little bit of a problem there for you, because that's, you know, how our clients feel during these volatile times. So this has been a fun segment for us here on the Greenlight Retirement Show. Hang with us. We're going to pay a few bills on this commercial break, and we'll be right back to talk a little bit more finance and financial planning. Hey, welcome back, everybody, to the Greenlight Retirement Show. We are in our last little segment here. We've had a lot of fun talking about investment planning, insurance planning, income planning, you know, asset allocation and things. I'd be remiss if we didn't talk about one specific subset of client that happens to be, and this again, educational purposes only, might sound and feel like you. Give us a call at 757-961-0700 to get your individualized financial plan, or book your own appointment at www.fitzwilliamsfinancial.com. From there, though, we wanted to talk about those who might be what I like to call pension rich. Maybe income isn't your thing. Maybe you got some assets, you have some investments. Maybe you've selected a survivorship, so you know your spouse is okay. You are good. You don't have to worry about outliving your income. There is one more retirement just in case I need to save some money. And those are those end-of-life expenses, such as long-term care. So you might be set on income, you could be set on investments, but one of those things that we've felt and found over time is that, you know, long-term care planning, end-of-life planning can be a concern, even when you have, you know, a well-set-up financial plan on the front end with the income. So how could you address something like that, or how do we address something like that in the financial planning realm?
Yeah, so one of the things that I love about what we do is when we meet with clients and we're able to help them with the life insurance side of things, being able to use a policy to protect your end of life. Nowadays, policies have amazing long-term care type benefits called accelerated death benefit rider, and it allows you to access your funds while you're still alive to help take care of you if you can't do 2 out of the 6 daily living activities, which include like feeding yourself, going to the bathroom on your own. And it's a huge help at those end of life times when you don't necessarily want to go into a nursing home, but you just want to be able to pay somebody to come and take care of your needs because you don't want your daughter changing your diaper, those kinds of situations.
Well, a lot of people say that sounds expensive. So how do you suggest someone fund something like that?
So what I like to call it is, or what you guys taught me to call it, is the CD alternative. You know, we have these clients out there, we have these people like you out there that have this huge chunk of money that's in a CD. Maybe it's in their Navy Federal jumbo savings account, things like that. But it's this money that they don't necessarily need right now, but it's not necessarily earmarked for anything. And it's just sitting there. And sometimes it might be, you know, making 1 or 2%, but that's not enough to like really change your life. So you can take these big lump sums. I think if you look at putting in, like, if you're in your 50s and you're a pretty healthy person, you take $100,000, you put it into a life insurance policy like this, and you might get $200,000 as a death benefit, maybe $250,000 depending on your health. And what it does is it's going into a death benefit account. So your money is still in the account if you decided to like take your money out and walk away, if you decided you didn't want to keep it.
So you can be liquid if you want.
It still can be considered liquid, but in the death benefit account, it's growing over the years. It's got this potential to continue to grow, and you don't have to make payments monthly like with other life insurance policies because you did this big lump sum in the beginning. I do see some people that would rather say, you know, I have all these pension accounts. I'd rather do an account like this, but I'm comfortable paying $5,000 a month or something crazy like that instead of a big lump sum. But you don't get the same growth in those kind of policies. I really do think that this is my favorite way of using life insurance is for that CD alternative and being able to create a long-term care policy, because long-term care policies of the past, the kind that your grandma had, those were the kind where you had to be in a nursing home.
Right.
You had to get a doctor to pick where you're going to go. And even then you were fighting to get your money from the companies. And if you went to the wrong nurse or something, then you were no longer covered. And it was just stressful for everybody involved. These kind of policies, you can literally pay your cousin to go on a cruise with you if you wanted to. It's really using the funds as you need for your end of life.
And what you're doing there, just so the audience knows, this is called collateralization, right? So what we're doing is we're taking an asset, assuming all the basic stuff, right? Good financial planning, you have emergency funds. This is, money that you are saying, you know what, I want something different than a CD that's going to provide me different value, such as this long-term care solution you're talking about. Then they take the money, they drop it into the account. It's liquid, like Corrine said. But what do? They collateralize that asset. They collateralize that $100,000, that $200,000 that they had in the CD, and they drop it into this program. And now they have a multiple, like you said. Sometimes up to 3 times, right? Or 2 times, 2.5 times, 3 times.
I've seen 4.
You've seen 4, yeah. I mean, it's amazing if
Age and
you
health.
think this is a value to you, right? Mm-hmm. And one thing we forgot to say there, Corrine, is, but you made it very clear, it is life insurance. Well, everyone knows that life insurance is tax-free, the death benefit, right?
Yep.
That is true, yeah.
But since you're accelerating the death benefit, which is what you articulated, and you're absolutely right, you're saying, hey, give me that death benefit not when I die, but when I'm alive. And so if you do that, that stream of income from the death benefit is actually tax-free, which is beautiful, because the probability of needing something like this,
very high.
extremely high. And if you can do it without per se coming out of pocket capital, right? Yeah, you're paying for something, but it's offset by the gain. That's amazing. Mm-hmm. And I'm very passionate about it. I love it. You love it. It's where we started, but it's an absolute game changer, and it's an excellent diversification tool. And once again, when you diversify appropriately and you use these hedges, then you can go full pedal to the metal on the other side of the table with whatever risk tolerance you want to take in the direct market assets.
Now, as far as life insurance goes, I do believe that everybody should have good quality life insurance as well that is meant for passing on to your heirs and
Sure.
creating a legacy. And there are a lot of people out there that have this like bad taste in their mouth when they hear life insurance because of policies in the past and bad advisors that didn't do them right.
Wasn't funded right. It wasn't set up right.
I mean, that's what
Yeah.
disclosure
Whole
Brian
life
was about to
versus-
jump in here and say,
Yeah.
ultimately it's a contract. Not every agent, God love all the agents out there, but not every agent's created equal here. This is a little bit more of a boutique type of a strategy. So do pay attention to your contract. There are some pitfalls that you could fall into if you do this thing incorrectly.
You could mess it up.
You can absolutely mess it up if you do it wrong. So if you'd like some seasoned advice on this one, 757-961-0700. Would love to help you out there. But, as we start to wind this down, what I hear you saying is, depending on what you got going on as a potential prospect, client, or whatever, you're doing this yourself, that you've got a percentage of your assets that are allocated to income. If you don't need income, or whether you need it or not, you've got that. You've got, you can silo some assets. Everybody's familiar with the bucketing strategy, where you have early life assets, midlife assets, and later life assets. We're just talking about that third bucket in this case scenario.
Yep.
And so if you can solve both of those, bucket 1 and bucket 3, and maybe you don't need 100% of your assets to do that, what does that mean that you have for the remainder? And Tim, this is the central tenet of your book. Do you have the green light to retire, that if you can solve your income with a percentage, if you can solve end of life with another percentage, and it doesn't equal to 100%, you got extra money, don't you, Tim?
That's right.
You know, I also wanted to just throw this out there when we're talking about life insurance policies and using them for long-term care. One of the benefits is that if you don't use it, it does pass on to your heirs.
That's right. So again,
it's not for waste. I mean, it's going to benefit someone tremendously.
We've covered the gamut. And so whether you feel uncertain about the times or whether you'd like a second opinion of what you've got going on, we here at Fitzwilliams Financial are here for you. Come visit us on the web at fitzwilliamsfinancial.com or give us a call at 757-961-0700. We'll see you next time.